The performance of Palantir stock has been incredible over the past year, with the stock having an impressive year-to-date return of about 266%. This makes it so that Palantir stock is trading for roughly 50 times its current sales. Does this mean the company is overvalued, or is this a good investment opportunity? In this video, you're gonna find out. For all of my stock analysis videos, I use the Warren Buffett analysis method, and this involves analyzing the company health, the product, the management, the market, as well as the company's valuation. And we want to do this for Palantir so we can know whether or not this represents a good investment opportunity for Palantir or not. Palantir's company health is good, and the way that we can show this is by first getting the financials for the company. I'm using the White Sheets plugin for this that works on Excel and Google Sheets, and what we're gonna do is get the annual financial statements. Now keep in mind the company has not been around for a while, so the historical data is not going to be that much. However, what we do see that is pretty healthy is a pretty strong growth in terms of the revenue. However, there's a little bit decrease, but I think now with the new numbers that were released, the company is back on track to have high growth. The other thing that is extremely impressive is the fact that the company has 80% gross profit ratio. This is unheard of. Really amazing for the type of company that they are. One of the things that you can see here, however, is that the selling, general, and administrative expenses are one of the largest items, so just something to keep in mind. And that the company, it is profitable in the last year. However, in the past it does have a history of losses. However, now hopefully that's not going to happen moving forward. One more thing to flag is the fact that the company does have shareholder dilution, and it uses the issuance of shares to be able to fund some of its operations. On the balance sheet, we also see good things as well. The company has quite a bit of cash available as well as current assets. Its current liabilities are not that much relative to the current assets. And most of the liabilities is deferred revenue, the current and the non-current liabilities. The other good thing is that for the most part, the stockholders' equity is consistently growing right here, and the total level of debt that the company has, it's manageable. Something very positive about the company is that while it does have a history of losses, what you can see here is that in terms of operating cash flow, the company has a positive operating cash flow now for a couple of years, which is really good. The company, as you can see here, is investing a lot into different initiatives. So we can see this is very positive for a growth company. And then in terms of the financing activities, we can see that again, the company does issue stock to fund some of its operations. Lastly, what we do see that is very positive is that the free cash flow is growing at a healthy rate. So just something to keep in mind as well. Now, when it comes to the company's products, this is possibly one of the most confusing things about the company. And this is because they work with companies in the public and the private sector. And when you work in the public sector, like for example, with like the military or anything like that, all that information is confidential. So they can't reveal exactly what they're working for and how they're getting paid for part of the revenue. But after reading a whole bunch of reviews, not just on Reddit, but also on different review sites, something that really encapsulates the overview of the company is that the management team of the company is also really good. You can see this is the name of the CEO, and I listened to many of his interviews and his writings. He's a very smart person with a lot of expertise in the space, which is the big data, big analytics. He also has a PhD, and I really like the way he thinks. He's a quite radical thinker. He really pushes hard for innovation. He really pushes hard against the status quo, and it's constantly pushing his team and himself deliver better products for the space. So that is very positive. The other supporting members are very experienced in the field as well. And it shows. I mean, the performance financially and in terms of the stock has been phenomenal. So they've put a great management team together. The market growth in the market that Palantir serves is really good. And this is the big data, big analytics, as well as machine learning and AI. and the company is really well positioned to take advantage of the growth in this market. The growth in this market is expected to be around 13%. So just based on that, as well as a whole bunch of research that I put into the company and what management expects, I think it's quite reasonable that the company can have high growth. In this case, I expect a growth of around 18% for this forecasted period right here. So if we refresh the data right here, put the 18%, and then it all comes down to what you believe is a reasonable price to sales ratio for the company. So in my opinion, and just looking at the historical data, which you can see right here, we can see the various price to sales ratio. By the way, all this data comes from Whitesheet, so that way if you update the ticker and just click on the formula, it's going to give you the latest numbers. You can see how this has fluctuated from 50 to 16, 6, 22, 38, 22, 11, which is a very high price for this particular company. Ideally, it would have been awesome to invest at this particular point where the market cap was low, even though the growth of the revenue was pretty constant. However, we're now at this point where the market cap is extremely high, so it's gonna be a turbulent time probably ahead for investors of the company. Even if they keep delivering these results, eventually the stock price might take a hit. If we look on a quarterly basis, we can see price to sales ratios around 15, 10, 8, which is a lot. It's definitely a lot. The company is growing a lot, and that definitely justifies a higher price to sales ratio. I think just personally, maybe you could put like an 8, maybe a 10. But other than this, like any other number above for a software company, I think it's very high. One thing to keep in mind is that the company has the moat in terms of the relationships that are building with companies in the commercial and as well as the public sector. There's a good moat there, but other than that, there's not much of a moat. I mean, there's other solutions like AWS or perhaps Google or one of these companies that can develop some offerings that could really rival what Palantir is doing. And so it's hard to justify a higher, maybe 15 at the max. So if the company is growing at 18% per year, which is a lot, and is doing that for this forecasted period, and then the terminal price to sales ratio is 15, which is still again very, very high, there's no way to make money out of Palantir. And this is why it is very important to do your analysis when it comes to stock investing, so that way you can realize this and not get bought into the hype where everybody's saying buy this stock with no real reasons why, and then your holdings just crash. So in this channel, we're here to avoid that, so I hope that you took this away. If you want to see other scenarios for the stock, such as like different price to sales ratio, you can see them here. I would just need to adjust a couple of things. So in this case, perhaps I would just pick higher numbers. For this to make sense, I would need to change this to like even higher. Let me just refresh the live price data right here. So currently the stock is trading for 60. So for this to make sense, let's see, 40. Yeah, you would need to have a terminal price to sales ratio of 40, which is absolutely insane, even with the forecasted growth that we have here. I don't see them getting a lot more growth because closing these contracts is very complicated because these companies are massive. There's so many bureaucracies involved. They do have big pockets, which is good, but that's the problem. And then a 40 just makes no sense whatsoever. I think a 10 is reasonable, maybe 15. And this is what the analysts are also saying for the company. They're putting price target between like 11 all the way to like 30, the ones that are reasonable. There's also some bulls as well that are putting higher price targets, but usually they're off. So it's very hard to justify this price. And then in this case, we're looking at a downside of negative 66%, which is why, in my opinion, you should not buy Palantir stock right now, but you should definitely keep it on your watch list so that, as you can see with Whitesheets, you can keep track of this relationship of the revenue and the market cap. And if there's a significant dip in a short time period, which I believe they could very well be, this is where you get into a stock and you get into the stock in a good price that's going to generate you a positive return. Let me know your thoughts on Palantir stock below. And if you've enjoyed this video, make sure to subscribe to the channel, and I'll see you in the next one.